Hello and welcome to Moneylife News and Views. I am Debashis Basu. One of the most baffling paradoxes currently confronting us is the inexorable rise of the stock market through the second half of 2021. Why is the market so resilient in the face of a raging second wave of COVID that started in mid-March? After all, India is undergoing its most horrific calamity since its violent partition and independence nearly 75 years ago, as perceptive commentator Andy Mukherjee wrote in Bloomberg. As he says, new daily COVID-19 infections have remained above 300,000 for 2 weeks now, the worst caseload the world has ever seen. The fear of virus is pervasive. Even the rich and the powerful are finding it hard to arrange a hospital bed or track down an oxygen cylinder. But in all this, the benchmark Nifty 50 index is down ever so slightly, clocking less than a 5% decline since mid-February. At 32 times earnings, almost double the valuations in China, the Indian market is super expensive. According to him and others, this makes little sense. If we agree that predicting how the market would move over the short term is truly hard, then as a corollary, we should also not expect the market to behave as per our expectations and assumptions over the short term, or we shouldn't be baffled when it does not. The stock market is a market of stocks. This may seem simple and axiomatic and obvious, but we lose sight of this simple fact very often. Stock market indices will reflect the performance of companies making up those indices and nothing else. The performance here includes current performance and perception about the future. For the indices to fall significantly, investors must believe that the majority of stocks in the indices will do far worse in future. After all, they put real money behind their investment, while opinions of experts like me or anybody else have no real consequences if we are wrong. So, if the market does not decline in the face of gut-wrenching pandemic, it would be prudent to search for reasons rather than dismiss it as completely irrational. There are two very strong reasons for the market to have rallied last year and to continue to remain firm today in the face of unprecedented healthcare crisis and complete absence of governance in many parts of the country such as Uttar Pradesh, Delhi, Karnataka and West Bengal. One reason is corporate earnings and the second, lack of alternative options. I'll discuss only the first one. One of the most important trends that investors track is the quarterly earnings reports of listed companies. This is the starting point of forming an opinion on whether a particular company or a sector is on the growth path or not. Many companies hold conference calls after declaring the quarterly results where analysts and investors ask questions and get additional clues about business trends. If they are not satisfied, they hammer the stock. If they are, then they continue to buy that stock and the stock trends up. Now here is what Aavas Financials recently said about their own business. As on 31st March 2021, the total number of live accounts was 125,591, which was a 20% year-on-year growth. Aavas's total branches have increased 10% from 250 a year ago to 280. The employee count was 4,336 as against 3,564, a 22% rise last year. Assets under management were up 21%. Does this look like a slowdown, a recession, or the devastating impact of COVID? Remember, this is for the same exact 12 months when India was hit by the pandemic. The management is looking forward to a 20 to 25% growth over the next 3 to 5 years. Against this information, to conclude that investors in Aavas are irrational, one will have to assume that the management is lying or foolish, or we have somehow far better knowledge than them. Now, for adequate disclosure, Aavas is one of the holdings in one of our PMS schemes. This is a story across hundreds of companies and dozens of sectors. Stefan Borjas, President and CEO of RHI Magnesita, which is a global company, but it has an Indian operation in the form of Orient Refractories, said in his conference call just last week, India was one of the star recovery markets in the fourth quarter of this year. And while he thinks that the next 2 quarters would be weak, obviously because of the pandemic, he expects volumes to come back very, very fast. These are his exact words. What is amazing and largely and remains largely unexplained is the huge demand growth and superlative corporate performance across almost every single sector we are seeing. Building materials, steels, textiles, plastics, and of course pharmaceuticals, software and chemicals. Supreme Petrochem, for instance, which makes polystyrene, reported a 232 crore profit in March quarter. Its highest annual profit in its lifetime was 179 crore, which was 3 years ago. Now, in one quarter, it made more money than it ever made in its highest annual profit-making year. At least now, after the results, we have a very, very plausible explanation for the rally. We had none when the stock market began its rally in May 2020 against the backdrop of rising COVID deaths, high employment, business shutdowns, the migrant labor crisis, worries about uncontrolled rise in bad debts, etc. Now, we tend to assume that there is a cause and effect between what we see around us and the markets. This is a common behavioral trait of humans to extrapolate from the particular to the general, from horrific deaths to economic slowdown and to market decline. The fact is, even when large businesses said that they were flying blind in mid-2020, the market still rallied, and an incredible business boom actually followed that rally, not preceded. This is not to say that the markets will continue to rally and there is nothing to fear about. And if the earnings slow down, or interest rates rise, or there's a sudden external shock, the market will fall sharply. And of course, for every single company, you will notice, even the high flyers, if their earnings are lower in March quarter, the stocks are being hammered. All I'm saying is that we did not know that the market would rally in the face of synchronized global economic, social and health crisis in 2020. We did not know that corporate profits would be eye-popping, and now we do not know any better about what the future holds. If you liked what you heard just now and you liked our earlier videos, please do subscribe to our YouTube channel, and of course, please forward this video. Thanks for watching.